Well, as you stated, the World Nuclear Association believes that primary reactor demand, is going to double. That doesn't take into account any increase in demand from SMR, small modular reactors, which probably won't be substantial for the next 10 years. But a simple doubling of uranium demand in a market right now that's undersupplied by about 30 million pounds a year is an interesting statistic. Remember that just because the price in the spot market has cleaned up from $20 to $100 doesn't in the near term increase supply. You can bring back the cameco and the kazatomprom production, which is about 30 million pounds. But above that, you have to find these mines. You have to permit them, which can take 20 years. You have to finance them, and you have to build them. So I think that the deficit persists for at least 5 to 7 years.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. There is a lot of supply and demand issues, speculation, and general happenings going on in the world of resources that many are very interested in. And today we're going to focus on and go a bit deeper into two of these resources, uranium and gold. And we're so fortunate to sit down with the Rick Rule to discuss these in some detail. Rick began his career in the securities business in 1974. He's been principally involved in natural resource security investments ever since. He has structured, led, and participated in literally hundreds of privately placed debt and equity issuances for resource companies operating internationally. He was the founder of Sprott U.S. Holdings and held the CEO position for 10 years. Rick is a sought-after investment conference speaker, having presented at hundreds of resource and investment conferences, including his own, over the last 30 years, and his resume goes much, much deeper than this. Rick, thank you so much for joining us today.
A pleasure. Thank you for having me on.
Yeah. All right, we're going to start with uranium. I'd like for you to start with your current 10,000-foot macro take on the nuclear energy market and uranium in particular. What does it look like to you?
Well, I think the nuclear energy market now goes from strength to strength. I've been around the uranium business for a very long time, as you know, and I've never seen a circumstance where so many different elements, from technology to economic growth, and the need for baseload generating, non-carbon generating electricity. The idea that I would be on the same side of the table, as an example, as the co-founder of Greenpeace around nuclear policy just amazes me. So the 10,000-foot view of the nuclear power industry is unconstrained by anything that might appear to be grim. One needs to say, with regards to the uranium stocks, that since the point in time that they were unpopular about 3 years ago, they've uniformly doubled and tripled, in some cases quadrupled in price. So I would argue that as a resource investor, at least in the speculative end of it, the easy money has been made. I believe the big money may be ahead of us. But the truth is, in resources, the sure money comes when you buy stuff that's so deeply out of favor that it's hated. That circumstance was in 2022, not 2024. We could talk about reasons, if you'd like, where the structure of the uranium market is changing, and why the structure of the changing uranium market is good for the uranium miners. But it's not going to be as easy in the future as it was in the past.
Mm-hmm. Yeah, so utilities will pay what they have to in order to get their supply, which is an advantage for sellers. And there's been for many years lots of excess supply in the uranium spot market. Utilities have been able to just pick up supply in the spot market to cover their future demands. But now, like you were talking about, we're in a different phase, more of a contracting situation. Everything is really set up. It seems to be a seller's market right now. It's just really very tight. Can you speak into this a little bit?
Yeah,
further?
that's important to understand. The spot market was oversupplied. In particular, it was oversupplied. Well, two things happened, really. The last spike in uranium prices brought the Kazakhs in the market, and they went from a standing start to supplying 40% of the world's market. Truly amazing performance. Simultaneously with that, of course, Fukushima happened, which cut demand, not merely in Japan, but also around the world, particularly Germany. So you had rapidly increasing supplies and cascading demand, which had the obvious impact on prices. What that meant, as you suggest, is that the utilities had no particular need to enter into term contracts for uranium because there was so much available in the spot market. Mm-hmm. The companies had no incentive to enter into term markets either, because that would result in selling uranium for $20 a pound that they spent $60 a pound making. In other words, they'd lock in a $40 loss. Over time, that changed. Marginal production got shut in. Both the Kazakhs and Cameco also shut in about 30 million pounds of annual production, waiting for markets to firm. My former employer, Sprott, went into the market on behalf of investors, bought almost 50 million pounds, taking out of the market as far as supply is concerned because there's no mechanism to sell it. And the Japanese have restarted their nuclear fleet. So the spot market now is not a place to buy uranium. It's extremely thin. Most days, the dollar volume in the Sprott physical uranium product exceeds the dollar volume in the spot market. One could actually say the Sprott market is the spot market. At the same time, many more pounds are being traded in the term market. The bad news about the term market is that it's not transparent. It's opaque. It's very difficult. It requires a lot of work to understand, in a very broad sense, the nature of a term contract between, say, a Cameco and a Duke Power. The good news is that these term contracts lock in floor prices for producers for as long as 15 years. There is no other commodity that I know of where the producer and the consumer can enjoy price certainty for 15 years, which means that when you're analyzing a uranium company with a lot of material sold in the term market, you have an unusually high degree of certainty around their revenue levels. And the combination of the certainty around revenue levels and the visibility to analysts should mean in the next 5 years that debt capital is easier to come by for uranium because lenders know the prices that the material will be sold for so that they can amortize their loan. And equity prices should be relatively higher because of the certainty with which equity analysts can make revenue forecasts. These are very important changes. Now, your listeners need to know that Cameco and Kazatomprom and others aren't going to voluntarily disclose these term contracts. You're going to have to do some real sleuth work in the quarterly statement, looking at how much pounds were sold, how much revenue was received. And companies increasingly are saying how much they have contracted. They aren't willing to say much with regards to price and terms, but you can work backwards to price and terms. While the the opaqueness isn't helpful, the simple fact that you have established market stability with these term contracts becomes extremely helpful for uranium investors.
Yeah, and I do have a few questions for you regarding Cameco and their latest statement that came out. But before we get there, there's a few supply and demand questions I want to ask you. And on the demand side, the World Nuclear Association expects nuclear reactor demand to double from here over the next approximate 15 years. And the data shows that currently there's about 440 reactors operating around the world, 60 under construction, and an additional 110 planned. And most of the planned or in construction reactors are over in Asia. Right. But experts agree that nuclear power is gaining traction globally. It's going to become a larger piece of the energy pie in the next decade and a half to 2 decades. It's also worth noting that multiple countries, including the UK, Belgium, and Japan, are looking to extend the lives of existing reactors.
Correct.
Can you speak into the setup for uranium demand moving forward?
Well, as you stated, the World Nuclear Association believes that primary reactor demand, is going to double. That doesn't take into account any increase in demand from SMR, small modular reactors, which probably won't be substantial for the next 10 years. But a simple doubling of uranium demand in a market right now that's undersupplied by about 30 million pounds a year is an interesting statistic. Remember that just because the price in the spot market has cleaned up from $20 to $100 doesn't in the near term increase supply. You can bring back the cameco and the kazatomprom production, which is about 30 million pounds. But above that, you have to find these mines. You have to permit them, which can take 20 years. You have to finance them, and you have to build them. So I think that the deficit persists for at least 5 to 7 years. The other important thing about the statistic you cited, which is the 60-something plants currently under construction, and between 110 and 150 in various stages of planning and permitting, is that these are extremely capital intensive. And increasingly, the lenders, when they are financing construction, are requiring the developers to have secured enough supply of uranium so that they can amortize the loan. And what this means, again, is that the certainty we have around the top line revenue is fantastic. As you said at the beginning of the interview, the cost of the uranium, primary uranium, pre-processing, before you turn it into rods or reprocess it, is well less than 5%, something like 2.7 or 2.8% of the cost of delivering finished electricity. So if the price of raw uranium, ex-processing or reprocessing, were to double, it wouldn't have a material impact on the cost of operating the plant. What would have a hugely negative material impact would be the unavailability of supply. The consequence of that is that if you're building an $8 billion reactor and you're borrowing $5.5 billion of it, the lender, be it Industrial Commercial Bank of China or Daiichi Kangyo in Japan, is that they are requiring the plant builder to lock in sufficient supplies to amortize the loan. And this is really changing the nature of the uranium business, changing it from an investor's point of view in a very positive way.
Mm-hmm. Yeah. And so I was going to ask you a question on this very topic a little bit later, but since you brought it up, really, if you take all this entire scenario that you just put out there, that even if it doubled from 100 to 200, it's not going to materially impact the bottom line for the end user. So they're going to continue to buy. They're not going to shut down these reactors over that. What level, realistically, could uranium go to and be sustained at where it's not going to materially impact the bottom line user?
It would appear, right? Well, first of all, the answer to your question, what price could it go to, is I don't know. The last uranium bull market we had, I remember, it started off at $8. And I said, you know what? This market could go to 40. And it went to 145 instead. So my long-term price forecasting track record, Gary, is unblemished by success.
But it didn't go there and stay there. It went and
no, it didn't.
Down.
It didn't.
My question is more of a sustained level.
What's changing rapidly is the term market. The spot market now would appear to be stabilized in the $100, $105 range. It looks as though the floor price in the term market right now is between $70 and $75. It is likely that term market can go up because the industry does not seem to be securing enough term supply. Mm-hmm. If we see a sustained term market in the $75 range, what I think you're going to see is enough price stability for enough pounds that both cameco and kazatomprom restart to the extent that they're technically able to. They're shut in production. It's important to note that you don't flip a switch. Mm-hmm. These restarts, while easier than a new build, are fairly complex. And I don't think that you're going to see substantial volumes of restart material coming on the market for a couple of years. I also don't think that this level. Well, I don't think that any level in the near term it enhances the near-term supply of new build material. There are two mines that I can think of in the world that could be restarted in the 3 to 4 year time frame. There are 5 or 6 projects that, could they be permitted in the near term, could be built in the 5 to 6 year time frame. But I don't see anything that can happen in the 5 to 6 year time frame that will impact supply other than an increase in reprocessing investment outside of Russia.
So that's interesting because you're literally walking right into my next question. The World Nuclear Association is saying the supply deficit is somewhere between 20 to 25 million and maybe even as high as 60 to 70 million pounds a year. But we've seen the two biggest producers, kazatomprom and cameco, both not meeting their production targets. So in your analysis, I mean, I heard it kind of, but how is this massive shortfall really solved in the next 3 to 5 years, or just flat out, is it not?
I think it's important to understand that the shortfall numbers that you gave are before and after the restarts. We have a 25 to 30 million pound shortfall after the restart of cameco and kazatomprom, assuming that their restarts occur without a hitch. Mm-hmm. Both companies have said that they are not going to restart until they have enough material contracted that the price that they receive is above the incentive price for other producers. In other words, they don't want to give away rock, and they also want to receive reasonable returns on capital employed. So you're going to have to see more contracting volumes before this marginal production comes into the market. I think the second thing that kazatomprom is beginning to experience, because the Chinese would dearly love more of their pounds, is that restarting an in situ recovery mine, while simple at a bench scale, is much tougher at a field scale. For those of your listeners who don't know what in situ recovery is, basically you're taking a sandstone formation that has disseminated uranium in it. You're running water through the sandstone formation, through this porous rock, basically with bicarbonate of soda. And enough of the uranium molecules adhere to the bicarbonate of soda that you can pump that water off and strip the uranium with a resin. Think of it like a water flood in the oil and gas business, but it's not as simple as just running water through rock. You have to maintain uniform pressure and absorption, or else the field does what's called cone, which means that one part of the water advances more rapidly than the rest, and you ultimately destroy the producing capability of the field. So this has to be done very carefully. Kazatomprom is doing it very carefully, which is a different way of saying very slowly. Both kazatomprom and cameco are allegedly behind time with regards to restarts. I attribute most of this to the fact that I don't know that they have as yet signed contracts of sufficient term that they feel adequately compensated. I think both companies understand that there is an impending supply budget, and I think they want to make sure that the term contracts provide them some upside in the out years. Mm-hmm. Now, what we've seen in the case of cameco has been that they had enough term contracts that are still in place from before relative to their production cutbacks, that these poor guys have actually had to go into the spot market and buy $100 material to fulfill $50 obligations. Certainly unpleasant. I don't know the extent of that, and I don't know if the fact that unpleasantness will cause them to accelerate the restart of their shut-in production or not.
Well, so yeah, I'm going to definitely ask you a few chemical questions, whether you can answer them or not. We'll see. But it sounds to me from that answer is that you feel in your analysis very strongly that the market's going to remain tighter for longer, to steal a phrase from the Fed, maybe. Yeah, the market's going to, the uranium market's going to be tighter for longer.
Two things could wreck it. One would be a Fukushima-style industrial accident, which could easily set the business back 20 years. And I don't know how to forecast that. Yeah. The other would be a recession, which made mines less financeable and reduced temporarily demand for electricity. So investors and speculators in the space need to examine themselves in terms of their ability to see the time frames that I talk about delayed by a recession or postponed for a long time by a nuclear accident. A nuclear accident would be, in every sense, in a human sense, but also in a financial sense, catastrophic.
Yeah, totally agreed. So I wasn't going to ask you this question on a recession and nuclear and uranium, but I have heard, since you brought that up, I have heard several economists speak to uranium being the one resource that they think would fare still very well during a recession. Do you share that?
I do, but I think there would be 18 to 24-month hiatus. Okay. During recessions, investors, including corporate investors, lose their sort of animal zeal. And I think that you'd see a real slowdown in contracting. Yeah. Maybe not for any real reasons. You also see a contraction in credit. The nuclear plant business, the utility business, and the uranium business are all capital-intensive, credit-intensive businesses. And the damage that would be done in the near term by a recession is difficult to overstate. By the way, I'm no economist. I'm a credit analyst. I don't want to tell you that we're going to have a recession. I don't know. That's above my pay grade. It's just my job to introduce an audience like yours who hasn't wasted as much time thinking about uranium as I have with all of the variables involved in making an investment decision.
Would you suggest that those like Cameco with contracts during a recession would fare better than those who don't?
Well, yes with contracts, yes with a very low cost production profile, and yes with access to credit. The really good news about Cameco is that most of its contracts are with investment grade counterparties, which is to say that they're with counterparties that can afford to pay them. I remember in the late 1970s, take-or-pay contracts in the oil and gas business with takers, mostly oil and gas traders, that couldn't pay. A contract isn't of much use if the counterparty has to obviate the contract because they can't pay. With regards to Cameco, what you see is a preponderance of investment-grade counterparties, which from a credit analyst standpoint is very useful. One would assume that much of the Kazakh export production goes to Tokyo Electric, JOCMEC, and China General Nuclear, which are also credit-grade counterparties. The counterparties that are purchasing Russian reprocessed materials are more variable. That's polite.
Yeah, for obvious reasons. So you were speaking a moment ago before we got onto the recession aspect about new pounds coming on. Do you know roughly how many new pounds are expected to come online in 24 and 25? And do you think that's going to be, even with the restarts, is that going to repair the current supply and demand imbalance? And the second part of that, what's the likelihood that the Sprott Uranium Trust, Yellow Cake, and even some hedge funds would grab a significant percentage of that new supply to keep supply tight and prices elevated moving forward?
Well, I don't know how Yellow Cake operates. I know that I shouldn't call it ours anymore. I'm not employed there. That the Sprott product works. The Sprott product needs to be selling at a premium to market in order for them to raise money, in order for them to buy pounds. So if the unit price of the Sprott product is selling at a small premium to the spot price of uranium, Sprott can buy. The challenge is that there are fewer and fewer pounds on the spot market. So there are days when Sprott has the money and they can't access the pounds without moving the market. To the extent that we see more material come on the spot market, then the possibility exists for that continued source of demand. Dialing back to your first question, I have done my very, very, very best with the spreadsheets available to me to anticipate easily returned supply through calendar year 2025. And I would estimate, and by the way, this is really rough because these guys are very private. I would estimate that between 30 and 45 million pounds of annual production could come on in the next 2 years. There's lots that could go wrong that would derail that. But assuming that nothing went wrong financially and technically, I see the industry having the ability to produce between 38 and 45 million new pounds by the end of calendar 25.
And that's with the restarts that you had mentioned earlier, right?
It's almost all restarts.
So then if the 60 to 70 million high end that the World Nuclear Association is putting out there, if that's even remotely close to being accurate, then even if they hit these production targets and they restart on time, they're not going to be able to close the gap at this point.
Correct.
Okay.
Now, we don't know really what the above ground inventories are. And we don't know the extent to which the Russians will be able to continue reprocessing used and spent fuel, which adds a lot of pounds to the market. So I'm not saying anything dire is going to happen. I'm not here saying, no ifs, ands, or buts, uranium's going to $300. I don't know any of that.
Right.
I'm not going to venture to guess. I can tell you this. Roughly 2 years ago, the fully loaded cost to produce a pound of uranium, including cost of capital, tax, all that kind of stuff, worldwide, not just the mine cost, but the total cost, G&A, everything, was about $60 a pound. Mm-hmm. I suspect with inflation that's going to move up. Now, understand that doesn't incent new mine production. The incentive price for new mine production was probably $70 or $75. The current price, were it to extend to the term market, would be sufficient to incent new production. So the price doesn't have to go up. The difficulty is that even with the incentive price being where it is, to find a mine, permit a mine, and build a mine, irrespective of price in the next 5 years, it's going to be very, very, very difficult. Mm-hmm. It's going to be a real challenge. The next real big mine that's scheduled to be brought in production as a new build would be NextGen's Arrow mine. Mm-hmm. That mine isn't through preliminary permitting yet. We're talking about a mine that's 400 kilometers away from any real infrastructure. Now it's a wonderful mine, to be sure, and it'll make a real difference when it comes on. But don't look for that mine to be started by 2025. Never mind finished by 2025. Look for that mine and others of its ilk to impact supply 5 years from now or 7 years from now.
So to me, the takeaway from what I'm hearing, and I don't want to put words in your mouth, so please clarify if I'm off, but that, the uranium investment community can get very high, very low, very quickly, right, watching day to day. But really, this is a long-term story that we need to just basically buckle in and enjoy the ride for a few years.
The bulls need to understand that the spot market price doesn't need to go up. $100 a pound is plenty. The bulls also need to understand that the spot price is irrelevant because the action takes place in the term market. It's really a frame of reference now. I don't think that the price of uranium needs to go up for the next year or year and a half. I also don't think that people should do price projections for companies based on the spot price because it's an irrelevancy. The challenge will be learning enough about the term market so that we can access the visibility that's actually built into the market. I think what the bears need to be afraid of is that uranium markets will operate unlike any other commodity market in the world with regards to stability of pricing for the long term and visibility, which means that the cost of capital to build a uranium mine may be 300 basis points less than other types of mines. And the certainty with regards to revenue projections mean that theoretically those cash flows should be higher priced than other cash flows because they're less speculative on a revenue level.
That sounds exciting to me.
An interesting place.
Yeah, really, truly. So I want to go back to the Fukushima aspect here. There's been a negative legacy stigma attached to uranium since Fukushima in 2011, and maybe even dating all the way back to Chernobyl. Despite the run up in uranium price over the last 18 months, how much of that legacy stigma do you think still remains? And would you say that it's been dissipating, or that there's kind of like a legacy hangover hold that's going to even be there for a few more years to come?
I think there's a very strong emotional hangover, particularly in Japan, where the Japanese people before Fukushima endured Hiroshima and Nagasaki, and where the Japanese people too believe correctly, I think, that they were misled by their government as to the safety standards and the risks imposed by their industry. And I think that'll take a while to overcome. On a broader scale, what you have is a population that is generally concerned about the level of particulate pollution, at least in China, and carbon emission globally. And a realization by even many people in what I would describe as the environmental community that there are 1 billion people on Earth with no access to electricity at all, and 2 billion people on Earth with access to only intermittent or unaffordable electricity, and that the world will acquire more baseline power. Those people in the environmental community need to make a choice between nuclear and coal. Those are their choices. Some of your listeners will say, oh, this old guy's crazy. What about wind and solar? Those people need to consider the arithmetic around alternative energies. We have now spent over $5 trillion, that's a T, trillion dollars, on direct costs associated with generative sources that are described as alternative, geothermal, wind, solar, all that kind of stuff. I've invested some of it myself. That $5 trillion investment has reduced the market share of alternative energies, reduced the market share of carbon-based energies from a high of 82% all the way down to 81%. A $5 trillion investment has reduced the market share of fossil fuels in the electrical generation mix by 1%. If you understand that we have to bring 1 billion people into the modern era, and we have to increase affordability and reliability for 2 billion people. This is before the electrical demands of things like AI and electric vehicles. This is just to provide baseline standards for humanity that are similar to the way you and I get to live. It's very clear to me that the only way that we're going to do this in a way that's acceptable in terms of loading of particulate pollution in the third world and carbon loadings globally is nuclear. No other choice.
Yeah, that's exciting. From an investment standpoint, that's exciting.
And Gary, it's important to know this isn't narrative, okay?
Yeah.
This isn't me talking to Greenpeace, or this isn't the WEF. This is simple arithmetic. There are 1 billion people on Earth with no access to power. 2 billion people on Earth with access to only intermittent or unaffordable power. The only way that you can service that community with reliable baseload power that isn't carbon generating, the only way is nuclear.
Yeah, and I think people believe narrative over, like you say, arithmetic, and they're going to come to learn it one way or another. I mean, that's just reality.
Right.
I want to ask you something on Sprott, the uranium trust. It's grown investment wise by about 10 times over the last few years, and the fund has returned about 3 times in about the same time. What amount of the investment dollars flowing in has been institutional money coming in, and do you expect larger institutional money flow into Sprott over the next few years as the price of uranium remains elevated and supply is tight?
As a very large shareholder, I'm delighted to say that all kinds of money has come in. Individuals, ma's and pa's, me. Family offices have been very prominent, but institutions, both large and small, have been in place too. So the demand for the product has been gratifying. The volume that you see in the product on the Toronto Stock Exchange suggests that there's still a fairly large retail component. You see large volumes every day that aren't chunky. The chunky volumes indicate institutions having to buy and sell. So the fact that the volumes are both large and smooth would indicate that there's been a reasonable mix between institutions and individuals. Certainly when the bull market started off in 2022, there was very little institutional interest. It was mostly retail individual institutions, interest. Much more recently, it's been both. Sprott's marketing efforts have been largely geared to the institutional investor.
Yeah. So I know that there's a size and liquidity issue for many institutions to invest in any sector, and the uranium sector as a whole, and specifically the individual companies, they're deemed kind of too small for institutional investing for that community, and likely too small and illiquid for the investors to even invest in uranium. And so I'm thinking that they probably have held off for a period of time, especially when the sector as a whole only was 30 billion.
Right.
Is the uranium sector still too small on the whole and too illiquid, or do you see it getting to the point where institutional investors will really start to invest in it heavy? And what do you expect to see from the sector and the impact to equity prices once that group of people and their money starts coming in?
There are liquidity constraints for big institutional investors. If you look at the market cap of the entire Sprott product, which is far and away the biggest product on the market, the liquidity is insufficient for, say, a Norges Bank. Smaller institutions, $1 billion, $2 billion institutions, there's plenty of liquidity for them. And there's a lot of strategic interest in the product. Ordinarily, you wouldn't have expected that product to interest Mubadala or Adik, the very large Middle Eastern institutions. But as they see themselves becoming increasingly reliant on nuclear power, sometimes there are strategic interests that supersede the normal liquidity constraints. The equity market's even more challenging. The only company that has institutional scale, governance, and liquidity that's suitable for institutional investing is Cameco. The ETFs in the space, including ours, the Sprott product, are really too small. The biggest one, if my memory serves me well, has about $6 billion in AUM, and it's not really a uranium ETF. It includes processors, servicers, nuclear utilities, all things nuclear. The largest pure play is, I believe, ours, the Sprott product, and there the AUM is sub $3 billion, which means that a large institutional order would consume a quarter of the fund. Obviously, funds don't like to be more than 9.9% of the vehicle that they engage in. So the market is liquidity constrained for institutions.
Do you see the market growing to a point where maybe it's not? And
I don't think it'll have to, because I think that strategic reasons will prevail, and I think there's so much money in the small institutions that you don't need the big ones. I mean, Vanguard, the big index guys don't have to come into the space because it's too small. And there are plenty of $20 billion institutions that can and will, or in some cases where they're state sponsored, must participate in the sector.
So it doesn't sound like you think at this point the trade is too crowded. It sounds to me like you think there's plenty of room for growth, especially on the institutional side.